Welcome to the Kaiser Report. I'm Max Kaiser. You may have heard that Amsterdam has begun paying alcoholics in cans of beer. That's right. In exchange for 5 cans of beer, a pack of tobacco, and 10 euros, the alcoholics clean parks and streets. The city's aim is to keep the drunks occupied so that they can no longer cause trouble in the parks. And indeed, one of these alcoholic park workers said that the structure has kept him out of trouble, but that if it weren't for the beer, he wouldn't bother showing up at all. I know what you're thinking. You're thinking that this sounds a whole lot like the policy of quantitative easing. And you'd be right, whereby central banks keep the debt-aholics obediently spending by giving them a seemingly free lunch of low interest rate credit crack. One could think of QE as Meals on Wheels for over-leveraged consumeraholic debt addicts. Of course, feeding the addiction merely hastens the addict's demise. But alas, it keeps the addict docile in the meantime. Isn't that correct, Stacey?
Max, they're trying to keep us debtaholics out here docile, of course, with all this quantitative easing. Apparently free money. That's the important thing. We feel like we're getting a free lunch. So we stay quiet and we keep consuming, or keep consuming debt at least. Now, here's the first headline about quantitative easing. What car salesman Ben Bernanke said at dinner last night. So this is Simon Black of Sovereign Man, and he was at a dinner with the National Economists Club, and Ben Bernanke was the guest of honor. He said, at one point during the evening, when pressed about whether his quantitative easing program was good for Wall Street at the expense of Main Street, he, being Ben Bernanke, flat out denied it, saying that such a premise is, quote, simply not true. He defended his printing $85 billion per month, suggesting that fixing interest rates at zero is beneficial for society because, among other things, it allows people to buy cars.
Right. Well, it allows people to go into debt, into ever deeper debt. And it's funny because this idea of giving the alcoholics in Amsterdam's beer to keep them docile and to keep them cleaning up the park, clean up their open-air prison. It reminds me of Walmart and McDonald's. It was reported this past week that they themselves are out there giving the equivalent of a couple of beers to their employees to have them come into the store and perform menial labor and slave labor. So this Amsterdam model is being picked up by the likes of Walmart and Amsterdam. The people that work at those companies, they don't have enough salary to maintain a living wage. They're partly homeless. A lot of them live in the parking lots outside of Walmart and McDonald's. They can't afford homes.
So what you're talking about is at Walmart, they're asking customers to donate food for their employees, and at McDonald's, they issued a notice for employees to how to keep yourself from feeling hungry by chopping up your food in littler bits and spreading it out over the day.
Exactly. How is that different than people just giving drunks beer to shut them up? Yeah. And of course, the Americans are quiet about it. They don't mind being treated like a drunk in the park. They love it.
So there we have it, is that Ben Bernanke confessed that what he wants with zero rates is to encourage the addicts to buy a car using debt. Remember, the car loans in America, they're stretching out up to 10 years now. It's like longer and longer. It used to be like 2 or 3 years the mortgage on your car would be. Now it's like 5, 6, 7 years. So, and it's a rapidly depreciating asset. It's not even something that is a wise investment. But there's also, on the high end, we're seeing record amounts of margin debt on the New York Stock Exchange. And this is a chart from Bloomberg, and it's the margin debt for New York Stock Exchange member firms. And you see the 3 peaks there. This is an image that tells 1,000 words, 2000, 2007, and today, as you see record margin debt.
Right. When you buy a car in America, it's just like money printing in America. You increase America's debt load. When you're buying stocks in America, you increase America's debt load. When Ben Bernanke keeps interest rates at 0%, he's helping to increase America's debt load until such time as the debt bubble pops. Everyone who issued the debt, the bankers, including Bernanke, get a fee on the size of debt issued. They don't make money based on profits and losses. They make money based on the size of the debt they issue. So when a car is a debt issue, a quantitative easing is debt issue. Getting a job at McDonald's puts yourself into debt. That gives fees to the bankers. It destroys the economy. It destroys society. It destroys everything but the fees for the bankers. And so we're just seeing it getting more entrenched in the global psyche, because now economies around the world, the ECB, the Bank of England, the Bank of Japan, of course, got this whole ball rolling. They've adopted this model of turning everyone into an open-air prison like like Gaza. So this is the Gaza model being writ large, and I've told the Palestinian Monetary Authority they should adopt Bitcoin to try to fight this, but I haven't gotten any word back yet.
And by the way, relating this to addiction, as you see with those debt peaks, what happens is the debt addict passes out. They collapse into crashes, these market crashes. So we're at the point where we're at a higher peak than the one in 2007 and a higher still than the one in 2000. So again, are we going to fall over like we did, just like the drunks in the park probably eventually fall over after the 6th or 7th beer?
Right. In other words, when the whole system crashed in 2008, the conclusion was we need better mathematical models to convince people that banks should get into deeper debt. The conclusion wasn't that we need to reform banks so that we don't have another crash. There will be another crash. It'll be much worse than the 2008 crash, just like 2008 was worse than the 3 or 4 previous crashes. There'll be an incredible economic duress, and there'll be an incredible confiscation of wealth, as usual, and the cycle repeats itself.
I was going to say, as we're likening this to addiction, this is like with the quantitative easing program and what they're trying to do with increasing new radical programs, negative deposit rates, things like this, is the new beer that they want to, the alcoholic beverages they want to concoct that won't give you a hangover. So you don't ever, there's no lesson ever learned. There's nothing to keep you from ever feeding the addiction.
Well, in the UK, there's a big argument about whether to lower or higher the price of beer or alcohol as a way to try to manage the fact that quantitative easing, and Mark Carney is treating the people in the population of the UK like open-air prisoners. And their policy is not to adjust monetary policy or to try to adjust the economy in ways that they're not blatantly ripping people off. The only trigger, the only valve, the only fulcrum upon which this economy rests in the UK is the price of alcohol. Because they know that Britons run on alcohol, more so than any other society in the world. In the US, it's gasoline, because it's that everyone's driving around, going west, driving around Route 66. It's gas. But and here in the UK, it's alcohol. That's what fuels the economy.
And again, here's the quantitative easing being fed to the markets. And, just like the guy in Amsterdam said he would not work if it were not for the beer. Here, people will not shop, they will not consume if it weren't for the free money. 5 years of QE and the distributional effects. Here's a chart of luxury retailers versus middle class retailers, the luxury ones being Tiffany, Coach, LVMH, and that is the burgundy kind of brown line. And the blue line is Macy's, Kohl's, and JCPenney. As you see, they moved in lockstep from 2003 up until 2009. That vertical line is exactly when QE started. And what do you notice? Oh, the luxury retailers soar away from the middle class retailers. So who is it benefiting? Who is this debt benefiting?
Right. Quantitative easing is a program of debt irrigation or money printing irrigation, where it's a new way for bankers to direct the printing of their cash into the pockets of people who shop at Tiffany's. And you see that the Tiffany shoppers are getting the money basically deposited directly into their accounts without having to go through the economy, wherein it might trigger wage inflation. So wages are depressing.
Yeah. While
Tiffany shoppers are getting more free money to go shop at Tiffany's or buy a Francis Bacon triptych for $140 million or an Andy Warhol silkscreen for $100 million. That's the new financial irrigation, financial engineering, that is quantitative easing. That's the financial innovation, is that they figured out a way to keep people's wages from inflating while they inflate the value of their ill-gotten artworks.
Yeah. And now that chart was from JP Morgan, and what they said that this is showing, what the chart shows, is that there are debates about whether a 0% cost of money helps anything except financial asset prices. All we know is that the Fed has a story to tell, i.e. cheap money is good, and they are sticking to it. More like sticking it to us.
Yeah. People are getting stuck. Bad. The quantitative easing is keeping wages low. It's a program of financial repression. Wage growth is below inflation by design. It's financial repression or financial oppression. It's an actual economic term. And it's what I call financial terrorism. And the reason I call it that is because it's creating jihad in economies around the world from people rising up against their terrorist overlords.
Well, I don't see any sort of rising up. People are willing to spend, as we see with this headline here, that is housing loans soar by 37% in 1 year. Mortgage lending is back with a boom, the Evening Standard is saying, and the addicts are being fed, and they're taking it. The last month's total is the first time 17 billion pounds has been breached since October 2008, when the British financial system's near-death experience condemned the home loan sector to a deep freeze. So now they're celebrating it. The fact that, like the addict hitting bottom, near-death experience that we saw in 2008 from too much debt consumption, they're like celebrating, like, we're back to that same point again. We were, hello, step away from your debt addiction.
Yeah, the zombies got a big debt transfusion, and they're celebrating before they have to be shoveled back into their coffins again. After the NHS gets privatized in this country, taken over by hedge funds, after Co-op Bank was unceremoniously murdered by hedge funds, they will go after these people in the prison business and privatize the UK prison industry. And people who are too in debt to pay their mortgage when it collapses in 12 months or so, they'll just turn their house into a prison, and it'll be run by an American hedge fund, or like Manchester United, run by Americans.
Well, there are some people who chose not to be addicted to debt, and those are people who will not take the debt drug that the governments and the central banks are feeding us to keep us quiet in the park. They're feeding us the beer to stay quiet, docile, and obedient, and easy to control. Some people are not obedient. Well, what happens to them? They buy gold, they buy silver, and now they buy Bitcoin as well. Furious gold slam down leads to yet another 20-second gold market halt. What do the following dates have in common? September 12th, October 11th, and now, November 20th. These are all days in which there was a forced gold slam down so furious it triggered a stop logic event on the CME, resulting in a trading halt of the precious commodity. In today's case, gold trading was halted for a whopping 20 seconds as the market tried to reliquefy itself following what was a clear attempt to reprice the gold and silver complex lower. Needless to say, there was absolutely no news driving the event.
Right, as I said 2 years ago, a year ago, 6 months ago, if you have a gold and silver portfolio, hedge the manipulation risk with Bitcoin. And so people who took my advice, they're having record profits in their portfolios this year, gold, silver, Bitcoin, like they had last year, like they had for the past 12 years.
Yeah, and this thing is what they're saying is a stop logic event, is a banging the open. It happened here in the UK. This is from the London Open. And it was 2,000 contracts slamming the market at the open. The day after the FSA, the Financial Services Authority, said they were going to investigate such manipulation, they're saying, we're in control of the market. You guys are not debt addicts. You're trying to protect yourself. We're going to slam you. The only one that's outside that manipulation, as you say, is Bitcoin.
Yeah, its gold is clearly being manipulated, and Bitcoin is the only way to get around it. All right, so we got to go.
Okay, well, have a good interview with Barry Silbert.
Oh, Barry Silbert of Second Market, talking about Bitcoin. Stay tuned. Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to go to New York City and speak with Barry Silbert, founder of Second Market, an online marketplace for buying and selling illiquid assets such as restricted securities in public companies, and on which he recently launched the Bitcoin Investment Trust. Barry, welcome to the Kaiser Report.
Thanks for having me, Max.
All right, Barry Silbert, tell us about the Bitcoin Investment Trust.
Well, I'm an early adopter of Bitcoin. I got involved a few years ago, and what most people realize very quickly is that it is very, very difficult to invest large dollar amounts in Bitcoin. You got to wire money to foreign exchanges. You got to deal with a very volatile market. And so what we did was we incubated a Bitcoin investment vehicle. And really what it is it's like a private Spider Gold GLD, where it essentially is raising money on Second Market and will trade on Second Market. And we handle all of the hard work of sourcing large amounts of Bitcoin. We handle the security, the safekeeping. It's audited by E&Y. And so the whole idea is to open up Bitcoin investing to a much broader group of investors.
All right, so basically it's like an exchange-traded fund, which is based on Bitcoin, but it's not exactly an exchange-traded fund because I believe it's only open to accredited investors, so you avoid that regulatory hurdle, correct?
Right. We were able to launch this in about 6 months. New ETFs could take years to get approved by the SEC. And at some point down the road, it might make sense for this to be in the public market, but for now, it's only open to sophisticated individuals and institutions.
All right, so as an asset class, and I remember when we were in New York recently, we were talking about this in your office, and we were discussing how hedge funds have got to look at Bitcoin as an asset class, because if they don't, they might find themselves lagging their peers in 6 months or a year. So with the hedge funds coming into this, I want to ask you, since you've launched the Bitcoin Investment Trust, has it now become an instrument for this hedge fund community? Barry.
Not quite yet. We're seeing three big groups of investors right now. We're seeing tech entrepreneurs who are excited about Bitcoin as a technology. They can actually invest in the Bitcoin Investment Trust via their IRAs now, and so that's been exciting for that group of investors. The next group are family offices. So what's interesting is we're starting to see family offices who have a very diversified investment strategy, long-term time horizon, taking a piece of their gold allocation, putting it into Bitcoin. And then the third group, it's Wall Street professionals, portfolio managers, traders who are not yet investing for their clients or their LP money. They're investing personally. And I personally think that this is the precursor to the hedge fund money coming to the space.
All right, well, Barry, if that's so, and you've got these early adopters, very smart money coming into Bitcoin in a space which is now roughly, let's say, $6 billion in size, and the Winklevoss twins, who you also have a relationship with in terms of the local Bitcoin and Silicon Alley community, they're calling for this to possibly achieve market capitalization of $400 billion, which would make it on par with the largest of the stocks listed on the New York Stock Exchange, like an Exxon, for example. Is that kind of the, are you in the same camp? Do you think this is where we're going?
I think the outcome for Bitcoin is binary. It's a highly risky investment right now. It's either going to be total loss of your principal or a fantastic return. And actually on the website for the Bitcoin Investment Trust, it's bitcointrust.co, we actually outlined 4 different scenarios of upside for Bitcoin. If it was the size of Western Union, if it was the size of PayPal, if it was the size of the monetary base of Turkey, and then the biggest one is 5% of gold. And if you take 5% of gold, gold's about a $7 trillion asset class, we're talking about returns of certainly well in excess of anything else out there.
Yeah, you mentioned comparison to gold and silver, and this comes up often. People consider this to be really the digital version of gold, or for gold to be the analog version of Bitcoin. It's funny, Barry, I want to get your thought about this, because a lot of folks in the gold and silver community, the libertarians, for example, they are slow to pick up on this thread. Where do you fall on this, Barry?
Gold has thousands of years of experience of being a known, trusted store of value. That's never going to change. I do think Bitcoin is potentially, for a younger generation, our generation's gold, because it does have the store of value characteristics and attributes, but it really is, from an intrinsic perspective, very valuable, because this Bitcoin network, this transaction network, is going to change the way that people move money around the world. It's going to change the way that people think about money. And from that perspective, I think it actually has kind of the best of both worlds, both money and store of value.
All right, now, Barry Silbert, I saw a tweet this week, and it really sparked a thought in me. Somebody was talking about Bitcoin in terms of the Bitcoin race, and kind of making an analogy to going back to the 1960s. We had the space race, where Sputnik from Russia was out there, and then suddenly America entered the space race, and there was a scramble to get man in space. The reason I bring this up, and the reason this is interesting, is because only, from what I've seen recently, something like 2% of the total volume around the world is US-based. A lot of it's China-based, Russia-based. It's all outside of America. There is a bit of a Bitcoin race going on. On the regulatory front, it seems like the US, they're still kind of looking at this thing and trying to figure out what it is, but the rest of the world is already going full bore ahead. Your thoughts?
I think that's 100% accurate. As I mentioned before, I was one of the early adopters of Bitcoin. I'm a pretty active angel investor. I've invested in about 15 Bitcoin companies, and it's been interesting to see how the narrative has changed here in the US from 12 months ago to 6 months ago to today. 12 months ago, Bitcoin was described as the Silk Road currency. It was described as a tulip bubble, Ponzi scheme, and you had some early adopters using it, embracing it, but not many other individuals. Then about 6 months ago, the FinCEN Department of Treasury came out and said, you know what, Bitcoin, it's legal to use, it's legal to own, but if you're going to operate as a money transmitter, then you just need to register as such. And at that point in time is when I saw the narrative start changing from this is a really bad thing to this is something that could be good but could be bad. Today, I think it's changing. I think what's happening right now is the US policymakers and regulators are realizing that companies are going to get created, jobs are going to get created, and innovation is going to happen. And I think here in the US, we would love to see that happen here. And in fact, we'd love to see it here in New York.
Right, but clearly Bitcoin is a competitive threat to an entrenched oligopoly of big money center banks who love their huge fees. And if I can move money around the world, millions of dollars using Bitcoin for pennies per transaction, that's going to huge body blow to these money center banks. So we understand they have a bias as to why they wouldn't want Bitcoin because it's a threat to their business. But nevertheless, I'm looking at statistics such as Bitcoin volume is now approaching daily volume of PayPal, and that Bitcoin volume is approaching something like 50% of the daily volume of money sent through Western Union. These are enormous numbers. Can you speak about this, Barry?
Well, yeah, I mean, clearly Bitcoin is very disruptive to a business like a Western Union or a PayPal. But trust me, the banks will figure out a way to make money off of Bitcoin. And in our conversations with all the banks, I think that there is enthusiasm about what this could do. There is certainly some concern about having to comply with rules and regulations around AML and KYC. But I think it's a global phenomena. And regardless of what the US or US banks think of Bitcoin, it's going to take off around the world, and I think ultimately the U.S. will fall behind if policymakers and regulators don't take a fairly kind of balanced, accommodative approach.
Now, Barry, Bitcoin has come around at an interesting time in history. It's come out at roughly the same time as the Edward Snowden NSA reveals, at the same time that Kim Dotcom had a spectacular run-in with the copyright cartel, the MPAA, on his mansion in New Zealand. It's quite a spectacular story. And then Bitcoin. And all of these things have one common theme, that theme being encryption. Now, as you've stated, you're a long-time investor in the technology space. You follow it quite clearly. Can you talk a little bit about how encryption itself is defining this currency, why that's important, and maybe why we see echoes of it in other parts of the culture that might validate Bitcoin's existence, Barry?
I think the history of Bitcoin I would break into kind of 5 chapters, and I think we're in chapter number 3 right now. Chapter number 1 was early hackers, people playing around with the technology, didn't view Bitcoin as a currency or a transaction network. That was the first couple years. Chapter number 2 were early adopters, early entrepreneurs, angel investors like me who got involved and got excited about everything we've talked about, the store of value, the encryption, the privacy, all of those things. The next group, which really started just this year, is the venture capital community who understands that the future of technology is going to be peer-to-peer. It's going to certainly rely upon encryption technologies. So we're in the middle of that VC chapter right now. The next chapter, which I think is 2014, is the Wall Street chapter. So this is when Wall Street starts investing money into Bitcoin and the Bitcoin infrastructure.
Are you also looking at a couple of these other alternative cryptocurrencies? The one name that pops up a lot now is Litecoin. What do you think, Barry?
I'm an investor in Ripple Labs, which is the company behind Ripple, but that's really more an investment in the founding team and the technology, less so the alternative currency. I'm personally not that excited about the alternative currencies because you have to remember Bitcoin at its core is software. It's a protocol. So any new advancement, any new tweak that other alternative currencies adopt, which gets traction, I think it's fair to say that Bitcoin can evolve over time to adopt that characteristic as well. So I'm personally not very bullish on alternative currencies right now, but it's still very, very early.
Yeah, I mean, you could imagine a scenario like the various fiat currencies today. Money flows in and out of these different currencies based on different macro events. And if there are 3 or 4 cryptocurrencies, you could see something similar happening. Finally, Barry Silbert of Second Market, I want to get your take on something. This is a bit more technical in nature, but you are a high-tech investor and somebody in Silicon Alley in New York, very well-respected, high-profile name. So let me get your take on this. Cody Wilson, who is, of course, the guy who brought us the 3D gun, has launched, along with his partner, the Dark Wallet. which they see as a conflict emerging between, let's say, one side are the validated coins. This is an attempt by folks like Matthew Mellon, another friend of the show, to come up with a technology to validate so-called validate coins versus going down a more anarchic path. We've only got about 30 seconds left, Barry. Do you have a thought on this?
Bitcoin will follow the way that US dollars are used. There will be a well-lit, well-regulated use, and there's going to be illicit private use. And I think ultimately both are appropriate, and both, it's not appropriate to try to shut down one, because I think Bitcoin at its core is an open protocol that anybody can use however they want to use it.
All right, fantastic. All right, Barry Silbert of Second Market, thanks so much for being on the Kaiser Report.
Thanks for having me.
And that's going to do it for this edition of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. I'd like to thank our guest, Barry Silbert of Second Market. If you'd like to get in touch with us, tweet us at Kaiser Report. Until next time, Max Kaiser saying bye, y'all.